Afternoon, everyone. We are going to start in a minute or so. I see a lot of attendees rolling in. All right, I think we can start now. So first of all, thank you for taking the time to come and talk to us. Again, this has become now a routine for us to do an economic update with our friends from Russell Investments. Remember, in the past, we used to alternate, but they have been so popular among our clients that we keep on inviting back. There's a lot going on in the markets right now. And we did the last economic update, I think it was February 18th or so. So we figured we didn't have to wait 3 months to bring them back. There's a lot, as I said, going on. So I am Elier Peraza. I'm the Director of Financial Services at Johanson Yau. And like before, I have Alex Russo and Mark Eibel from Russell Investments to give us their perspective on everything that is happening. So I am going to uh, transfer it to Mark. Mark, take it away and let us know what you guys are thinking about the market and the economy right now.
All right, hang on. I just had there we go. I'm good. Yeah, just a couple opening comments. What an interesting day to do this. I mean, I can start with the most important news, which is it's 2-2 in the Mariner game in the eighth inning against the Twins. It's an afternoon game. So, being a Seattle guy, that's my number one news item of the day. But there's a few other things that happen before we get into um, the normal kind of talk. So we had a Federal Reserve meeting today. Very, very likely, I think it is Chair Powell's last one officially. But he's staying on as a governor. So, which was kind of the big news, I think, of the session. He has that right to do that. He just goes from one end of the table, I think, to sitting at a different part on the table. But he's staying on as a governor. He will not be the Fed chair, but he'll still be on the committee. Most Fed chairs, when their term is over, exit the entire thing. He is, for a variety of reasons, decide to stay on. Second news is the vote was 8-4, which is pretty tight. I don't think we've seen four dissent votes since 1992. And all that means is that the overall decision was to keep rates where they're at, and we all kind of knew that that would be the way that this was going to go. But the amount that are giving a little bit more attention to the inflation side kind of increased in this particular meeting. So you have much more of it's not a consensus view, so to speak, on the Fed. So that was also news today. The other thing that we have seen is oil touch $120 a barrel today. Prior to, and it backed right off and it's sitting right around that level. It's gotten close to that. And 120 is just one of those weird numbers with oil. A lot of people associate $120 a barrel with recession. Not really sure how that number picks it, but that's it. So it gets close to it and then it pulls back, and it gets close to it and pulls back. Now, it would have to stay there for a significant amount of time. So it's kind of like whenever a significant bear market, like when the Dow crosses 50,000, 60,000, it gets all this attention, but it's just another number, right? So it would have to sit there for a while, meaning months. And quite frankly, maybe have to go even higher to 150 to probably trigger a recession, because today's world is a little bit different than, say, the comparisons that get talked about like in the 70s. 70s, oil was a bigger percentage of our overall budgets. We did not export, we only imported, and that was a true energy crisis. But still, the fact that it's dancing around $120 a barrel gets people kind of wondering all about it. And then the third thing that we have, which is probably already kicked off, but will kick off during this call, is like the four big names in technology. So basically, four of the largest companies in the world are all reporting earnings at the same time after the bell. So extraordinary day in markets. And for all of that, the S&P was flat, which kind of summarizes where we are at this year. Despite everything that has gone on, the markets have been remarkably resilient. You're up about 5% on a balanced portfolio year to date. You're up probably 2% plus if you're very conservative, and you're probably up 7 or 8 if you're very aggressive. For 4 months in, if you had told me 4 months ago that's how the market was going to play out, I'd say, well, it looks like nothing really dramatic is going on in the world. Remarkably resilient market. And we'll probably zero in on that theme as we go throughout the slides. So this deck is built for first quarter, but I think you have to recognize kind of what happened during it. So I'm going to go through kind of some of my favorites out of a 25 slide deck. Don't panic. I'm going to go through probably about 6 or 7 different slides. We'll hit a little bit on the war. We will hit a little bit on midterm elections, which are coming up. And just kind of why is this market staying where it's at, and where have we been, and maybe where are we going? So great time to do this call, and we'll just have to see how it plays out. So we're going to start on slide number 8 in the deck, which is kind of a look back of first quarter. So actually, let's go to 8. No, keep going. No, I think we passed it. No, that's the one. Thank you. So my mentor in this business, and really the first strategist at Russell Investments, and actually was my economics professor as well, was Ernie Ankrum. And Ernie Ankrum would have called this the Rip Van Winkle year. Now, many people in the industry use that term. I think Ernie used it decades ago. I don't know if he started it or not. And of course, we all kind of know the story. You go to sleep for a long period of time and wake up, and you know what's going on, right? So if you went to sleep on New Year's Eve and woke up at the end of the first quarter, you're kind of going, well, it's a pretty boring quarter, right? I'm kind of right around where I was at. And that's what this slide kind of demonstrates. But we all know the path that we got there, because war broke out halfway through it, right? So what you see in the top half is really what markets were doing for the first half of the quarter, and then what markets did in the second half of the quarter. And then the final result is, yeah, you're down 1% and change kind of on a balanced portfolio. Now, the media loves to focus all of its conversation on the bottom half of the chart. It wants to shock you. It wants to use some really dramatic terminology and tell you how much the market is off of its highs. What it doesn't tell you is you might have lost. I mean, let's take emerging markets, which it tends to have a little bit more volatility to it. Yeah, I mean, you're down 13% at one point in the quarter. What it doesn't tell you is, by the way, you made 15% 20 minutes earlier, right? So when you put it all together, it's been a pretty balanced quarter. It's similar to what we saw around the tariff effect. Remember April of last year, when the market had this big downturn and then shot right back up. And if you looked at a 6-month snapshot, you kind of didn't know any of it happened. So it has that feel to it. There's volatility on a daily basis, maybe. And even in historical terms, I mean, we're nowhere close. I mean, you want volatility. '08 was volatility. I mean, we're nowhere close that kind of level of 2008 and what we were dealing with then. But you do have more moves both to the up and the downside. And when you sort it all out, you've done all right. And again, if you don't even look at the snapshot ending March 31st, and again, in a long-term time horizon where we're talking about your retirement assets and living decades after you retire, a one-quarter snapshot, I mean, it's like that, right? But if you look at April's been phenomenal. So through April, again, that's where you get these numbers where 4 months in, up 5% on a balanced portfolio, looks pretty good. So always just kind of remember the lens that you're seeing the news that's being reported to you. I'm not telling you there's not dramatic things going on. Obviously, we know what's going on in the Middle East. And again, a day like today with the Fed chair, it's earnings season. And earnings have been great, by the way, and we thought they would be. That's one of the reasons why this market is staying at levels I think that it is. I mean, there's always a lot going on, but your portfolio or your performance might be different than what you think it might be. So just kind of setting the backdrop on this. All right, let's move forward from here. Let's move forward from that one. I want to sit on this one for just a second. This is a way, I mean, if you really follow this stuff and if you talk about this to a lot of your friends, I might have a way for you to win your beverage of choice in the establishment of your choice with your friends. This is the last 5 years. This is commonly called a quilt chart in the industry. Many of us use this to just kind of demonstrate how things move in and out of favor, and it almost looks random. And that's kind of the point of the quilt chart. What wins today doesn't always win tomorrow, and this is just a kind of a nice graphic way to show it. Well, this is the last 5 years. So you've got each individual year leading up to the 5 year return on the right. Now, for most people who follow the markets, if I asked you, well, what's been the best place to be for the last 5 years? 99 out of 100, myself included, before we created this chart, would have said, well, it's got to be U.S. large cap growth names, right? That's the technology names. That's the Nvidias and the Microsofts and the Alphabet slash Googles and the Apples. I mean, that's been dominating the world. It's got to be by a long margin, probably the best place for the last 5 years. It's right up there, but by point 0.1%, kind of the exact opposite has now been the winner for 5 years. Non-US names, and not the growthy names, but the value names, which are more the cyclical, slower growers. A lot of financials might be in there. A lot, really kind of a cross stream, everything other than technology kind of names has all of a sudden taken the lead. And why? Well, it's because of that 2025 number where they were up by over 40%. Now, again, I've talked about US versus non-US weights in this call every single time I've been on this call. I'll talk about it again today. We continue to be 2/3 of our money in the US and 1/3 outside the US. And people always say, after a run like we felt, why do I have any money anywhere other than the United States? Well, it's because this is what can happen in environments. I mean, emerging markets is at the bottom of that 5 year chart. Most people don't talk about it. Emerging markets were up over 30% last year. One of the drivers of that was simply because the dollar weakened. And that helps non-US companies for a variety of reasons. So, and that's starting to come more in favor and has actually been the leader so far in 2026. So we want exposure to these names for when they have their run. And there's great companies outside of the United States. We don't have a monopoly on great companies. We just have kind of the flashier ones almost, right? We have the big technology names. Uh, the same version of that outside the US, particularly in Europe, is luxury goods. It's like every luxury good now seems to all roll up into a couple companies, most of them based in Europe. So they do have their growthy piece too. But you just get a lot of good companies outside the US. So this mixture of having the two, still think the US is the best economy in the world for a variety of reasons. And it's such a big piece of the overall market. Yeah, we're very comfortable with 2/3 of our money here, but we're sure glad we have that 1/3. And this chart just kind of shows you you're starting to get paid for it. Now, I've been at Russell for over 40 years. I've seen a few things work and a few things not. I've seen everything on this chart work and everything not. When I started my career, Japan was at the top, right? I mean, Japan's got it all figured out. Remember, Japan's got it all figured out. Well, then for about 35 of the 40 years of my career, wasn't such a good place to be. And now Japan's back in favor and actually a slight overweight, I believe, in our portfolios at this point. My point is I saw that win. I've seen U.S. win. I've seen U.S. lose. I've seen emerging markets be the best place for a decade while we were the worst place to be. They move in and out of favor. So we would rather have exposure to them all and then just turn the dial up and down a little bit when we want to lean left and right rather than be all in or not in one place. So, but I just kind of thought that, I mean, what ideally the one do you look at here? You look at the blue one. That global equity that represents the whole world, and that's what our portfolios look more like. Not surprisingly, it tends to kind of be in the middle. It's generally never going to be first because it's everything, and it's not going to be last, and so it's a more consistent ride. And 9.5% over a 5 year period. It's not I would imagine that fits into a lot of planning assumptions for what a lot of people would like to see, probably above many of them, quite frankly. So I just think this is an interesting way to kind of see how things can shift in the world. That you don't always see, or quite frankly, you might not always hear about. Again, any business media anywhere in the world, quite frankly, is very geared towards their home market because who watches it? Their home market, right? If you watch the networks, you probably want to know what they're talking about in the US because you live in the US. And so they spend less time talking about other places, where in other places they might talk about, again, their local environment much more than we would in our media. So this just gives you kind of a little bit broader picture of what's all going on. All right, enough on that one. Let's go to I think it's the fixed income slide is probably the next one. So this ties in again. Today was for anybody who's the Fed watchers in the world out there. Powell just got done with his last press conference. You've had coverage since basically I'm a West Coast guy, so it starts probably around 5 o'clock in the morning here, and now it's 1 o'clock in the afternoon. So you've had a huge dose of a lot of Fed speak. What this just kind of shows is where interest rates are at. So this is commonly what is called a yield curve. It takes into account all the maturities from cash. That's what you see on the 1 month on the left, up to a 30 years. That's typically the maturity range of securities that you can buy. Now, what does the Fed really influence the most? That cash part. Basically, everything from 1 month up to 2 years, a Fed decision is gonna dramatically impact. Beyond that, it doesn't impact it as much, which is so interesting to me because this president's been very vocal about it, but quite frankly, most presidents are vocal about Fed policy. It's a great place to be in because usually it's a one-way conversation because the Fed chairs never respond. But the economy is basically in this 5 to 10 year range. Okay. Mortgages is probably one of the, well, that goes out to 30, but you start getting into corporate bonds and mortgages, longer term market views. And the Fed controls the short end. But no matter what the Fed does down in those 0 to 2 years, well, it might not impact things on the longer end, which is really what moves the economy. So that's why it's always interesting to see how this plays out between the verbal back and forth with all this. So what you see on here is what has happened over the last year. And then let's go to that 1 month part on the very left-hand side. You've seen interest rates have dropped pretty dramatically from the little dotted line all the way down to 374 because interest rates were dropping because well, the Federal Reserve was lowering interest rates, and there was a belief that that would continue into 2026. And we were in that camp as well. We thought the Fed would probably continue to cut interest rates once or twice this year. Well, then war breaks out, and it tends to happen in places in the world that has energy. That's nothing new, and we'll get back to periods like this in just a few minutes. Which means people get more worried about inflation. And the more you worry about inflation, interest rates tend to move up in inflation to compensate for it. So what you see as you move out into these other time periods, 3 years, 5 years, 7 and 10, you've actually seen interest rates move up a little bit because that's the market's way of saying, okay, I know the Fed was going to lower rates. That's why that moved down. But the economy is influenced by inflation and it's drifted up a little bit. Not much, but just a little bit. So that's the shape that we have as we call it today. So what does this mean for your portfolios? You're still clipping your 4 or 5% interest rate that you've been doing for the last year or two, right? I mean, that hasn't gone away at all, and that's a nice source of return. And really, the part of the where most of your investments likely are, if you're invested in bonds, is out in that 5, 7, 10 year range. Rates haven't moved around very much. So you're starting to see, and you've seen this year, you've seen positive returns so far to your fixed income portfolios, largely because of this coupon that you're just kind of, well, I always use the term clipping coupon. It's an old term in the industry because you used to actually get like a coupon book with your quarterly payment, and that's how you got paid interest. That's how old I am. So that's why if you ever hear the term clipping coupon, it's like clipping a coupon out of a newspaper back when we got those, and you would take it to the store where now you would digitally show it on your phone, right? Same kind of concept. All right, so you're clipping a nice coupon rate, and I still think, because again, I don't think this war, for political reasons, as we'll get into the politics slide in just a second, it can't go on too much longer. And I think as soon as we've already seen it, whenever there's been any sort of ceasefire announcement, boy, the price of oil just plummets, right? Starts working its way right back to 80, which is probably its natural kind of resting place, is somewhere between 80 and 90. All of a sudden, the inflation conversation probably goes away, and we're right back to talking about stuff we were talking about 6 months ago, which is, will the Federal Reserve cut rates? So I still think the direction of travel is for rates to move lower, which actually makes the value of your bonds move up. So in the meantime, you're clipping a nice 4 to 5% coupon with probably a reason where you might get a little bit of a kicker moving forward. So bonds have been performing the way we would expect them to. They just don't get talked about as much because of this extraordinary stock environment that we've been in. And now we're going to go to a slide that talks about the third asset class that we really don't tend to talk very much about. Let's go to the infrastructure one. I think it's on 17. Infrastructure is an asset class that we've had access to in portfolios for a long period of time. Well, probably 10 years or less. It's a newer asset class. And it kind of gets lumped in with real estate investment trusts, global REITs, not mortgages, but just everything else, kind of commercial real estate, and some sort of commodities. Kind of gets lumped into a category called real assets. So when we look at overall asset classes that we can use. I mean, stocks is usually the biggest weight. Stocks and bonds, depending on your risk profile, are going to be by far most of the weight in your portfolios. And then there's this third asset class that is a much smaller weight, but it's these other three areas that I just mentioned, and infrastructure is one of them. Now, infrastructure is getting all the talk right now because everybody's talking about AI, building out data centers, which fits into this category, as well as upgrading energy grids, all that kind of language. Well, that's all infrastructure. And so it's gotten an awful lot of publicity. It's had very nice returns as a result of it. But we've been accessing it across these other areas. These are more the traditional areas. So what you see here is just kind of what's all included in here, right? I mean, everything, transit, bridges, aviation, toll roads, dams, all of that kind of that stuff. Now, the letter ranking is not what the bonds are rated. It's just kind of whoever was the source of this. It's kind of what kind of grade is this? And this is the U.S. And we all probably know our infrastructure doesn't get a very high grade. It's pretty old. And we see that throughout what we call the developed world, which is the United States, Europe, Canada, Australia, Japan. Developed markets. Everybody else is more of an emerging market. The developed world, we built this stuff a long time ago, and we've all gone through projects in our area that always an inconvenience to our life. They take longer than we think they will. They cost more than we think. And then when they're all done, we go, this is so awesome. I'm so glad they did it. But the road to get there is hard, right? So that's the existing marketplace, the existing developed markets. We're replacing old infrastructure. And in newer parts of emerging markets that are building factories and starting to join much more of a modern economy from a global perspective, well, in many cases, they're building it from scratch. So it's being built, whether it's replacing or building it from scratch. And just in the US, I mean, on here, this is trillions of dollars that are going to be spent. So that's not going to go away. And if anything, again, it's been enhanced. Maybe we need to add a new category, which is data centers on Mars. The moon and Mars and everything that might get built up there. I mean, who knows where this all goes? But again, it's an area that gets talked a lot more now. It's a smaller weight generally in most people's portfolios, but it's been a nice place to. And if you believe that we're going to continue to build this stuff out, it's nice to have access to it. So we thought we would just put in a chart here to just kind of explain it as an asset class. All right, we're going to talk about politics and war to end up this fun little chat. I'll stay away from religion. I'll let you guys do that on your own, but I'll hit the other two things that are really fun to talk about with family. So let's go to the next one, actually. I want to go to keep going. I think it's 24. Keep going. Okay, yeah, we'll go to this one first. Actually, I think I'm wrong. Let's go back. Let's go to 20. I think it's 20. It's the longer term chart on the price of oil. Let's keep going. Not that one. Let's go to that one. Okay. So I love exhibits with long time periods. I've said that probably on every single call because you've been through this before. And these aren't just charts. These are your life, right? I mean, you've lived through this. So this is other energy kind of shocks going back to the 70s. Now, the 70s, again, 70s was a different deal. I remember I was about 9, 10 years old. I was a kid in LA at the time. I remember being in the car with my dad in the gas lines. I remember that. And again, remember, we didn't do any sort of real exporting. It was importing. And energy was a bigger part. Now we have, technologies and efficiencies that energy is not quite as big of a weight as it used to be. That one was dramatic. What you see on all the other ones really since then is it's just a nice reminder. We've been through this before. And again, everybody on this call knows that. And it always, war tends to break out in parts of the world in which there's energy located. It's been that way for, quite frankly, thousands of years. Hasn't changed too much. And what happens? At some point, there's a resolution, and at some point, there'll be a resolution here. On any given day, the U.S. can declare military victory. Iran can claim victory because they're still around, and they've disrupted things. Everything else will get negotiated, and eventually, that's it. And you and I don't determine when war starts. We don't determine when it ends. We don't determine what the Fed is. We don't determine any of that, right? What we do determine is three things that I'm going to get to on my wrap up. But and one thing that if you really want to worry about, you can worry about. So I'll leave that as a tease for getting there. But we've seen this before, and we know what happens. Oil spikes. There's a little bit of volatility in broader markets. Eventually, it gets resolved. Oil comes back down, and we all move on to kind of our next crisis. And again, we can all debate whether this war has made sense or not. Was Iran close? Was it not? I don't know. I'm not in those rooms. I don't know that. But I just look at the pattern of history. You've gone through kind of the drama, even though your portfolios haven't really caused you drama. It's exhausting. And I'm not trying to minimize war at all. My son's a is an Army Ranger. I get it. I understand the stress it puts on families and what is at stake here. I get all of that. I can only look at it, though, from a market perspective that says, I know the pattern this is going to follow. And if I've already been through the volatility of that, I want to be there when this gets wrapped up. And we saw hints of what that's like a couple weeks ago, right? Remember the first ceasefire? And if you think you're going to jump back into the market in time, I hope you don't sleep because the futures markets, the Dow futures moved up like 1,100 points overnight. Emerging markets were up 5% before the market even opened, and you really got a chance to trade on it. So it's very violent off the bottom, and you want to that's what we call good volatility. You want to be part of that, right? But if you think you're going to get in front of it, trust me, there's folks that, we work 24 hours a day, and there's a reason, right? So, but I just want to point out to here of the pattern of you've been through this, you can look at it, you can remember most of these, if not all of these, and this is the way the market kind of comes out. All right, now let's go to 24 with politics, and then we'll wrap up on 26. This is the year of a midterm election. And again, I don't think the political realities of that are lost on the administration. There's two numbers that really matter on here. Number one, the visual. So this is what the market does going back to basically post-depression. So starting with Roosevelt, kind of 34. Both parties basically in charge half the time. I always tell people half the time you win, half the time you lose. And I don't think that pattern's not going to change. Midterm House of Representatives very, very likely to go to the Democratic side of the aisle because, as the bullet point shows out, 87% of the time, or nearly 90% of the time, the minority party gains seats in the midterms because that's what we do as a country. We're all in, and 2 years later, we want to go back where we were, and then we go back to where we were, and you end up with these colors where half the time you win, half the time you lose. 74% of calendar years over the last 100 years, the market's gone up. So whether or not you're on the winning side or the losing side, 3/4 of the time you win. So it's generally better just to stay in the game than it is to get out when you lose. Because if you get out when you lose, you'll be out half of your life, and you can't afford that. So that's the first thing. What's interesting on here, and the data almost scares me because I don't like ever saying it's been 100%, but quite frankly, it's been 100% of the time the year after the midterm elections, no matter which party's in charge, has been an up year for markets. It's kind of interesting. Maybe we all just go through all the drama leading up to it, and then there's a relief when it's over, and the markets tend to rally. And again, the second one is that number. Don't be surprised if it's split party. I think the longer, I wouldn't have thought 3 months ago the Senate was in play. The election calendar is very much against the Democratic side of the aisle. The elections that are up for re-election in the Senate are tough ones. A lot of them are in areas that President Trump won by a pretty big margin. So I would have said, there's no way the Senate's going to flip 4 or 5 seats. Longer this goes, the closer it gets to election day. Yeah, I think the probabilities are probably 50-50 right now. So we'll see. And all those probabilities can flip in 10 minutes. There could be a resolution of this war before this call is over. I mean, that's how quickly these kind of markets move. But this is what markets do after midterm elections, no matter which party's in charge. And I mean, 90% of the time almost, there is a change in control. Okay, let's wrap up on the last one. And then my closing 3 things I've learned in 40 years and what to really worry about. So this, again, long time periods. Love this chart. This is just, I'm going back to World War II. I mean, this is what markets do in periods of war. And if you look at adding all of them up, and this only goes out 1 in 3 years, which is probably pretty short for everybody's time horizon, but you're pretty glad 3 years out that you kind of stayed in the game because, it probably makes sense once it gets resolved. Takes a big uncertainty off the table and markets move forward. So kind of similar to the exhibit that we had related to energy. You've kind of been through the at least emotional drama, the exhaustion. Again, markets haven't been as negative as they've been in some of these time periods, so you haven't had that piece of it. But once you get resolution and come out the other side, you're glad you stayed in the game and didn't just like go to cash. which kind of leads to my conclusion of which there is no charter slide up. So the three things that I've learned, and I already kind of alluded to some things you don't control. Don't control when war starts. Don't control when war ends. Don't control anything that's going on at the Federal Reserve, anything that was heard today. Most of, if not all, of what you hear in business media, you don't control any of it. So that's why I think watching it should almost be more of a hobby, if that's what you enjoy doing, than something where you're going to act on it because you're going to get conflicting views every 30 seconds. That's part of the debate. And you don't control any of it. You control three things. Number one, have a plan. You're on this call. So you've been invited to this call. You're a client of Elier. You're okay. You've accomplished number one. Good job. Number two, if you have a plan, you have a lot better chance of staying in the game. And that's what it's all about in my whole messaging throughout this. Again, 100 years. We had this in our economic and market review last quarter. Going back to 1926 is the data source that most of us use for the U.S. market. It's the cleanest data. 100 years. You've averaged about 12% a year. That's basically 1% a month for 100 years. Remarkable. Shows the power of the U.S. market and the U.S. economy, right? You got to stay in the game in order to get that. And you've got to live through a lot of this and a lot on the oil shocks and any recessions. You got to live through a lot of stuff in order to get that, but you got to stay in the game. And number three, where appropriate, manage taxes. If your investments aren't susceptible to taxes, you don't have to worry about it if they're in retirement plans. If they are, then you should, focus and work on that. Those are the three things that we actually control as individuals. You do those three things, I'm pretty confident the market's going to take care of all this other stuff because it's been doing it for long periods of time. So those are the three things that I've actually learned. The one thing, if you want to worry about it, worry about longevity. I just took my 92-year-old dad. I might have brought it up in the last call, but I've had probably 4 appointments since then. I took my 92-year-old dad to his annual wellness appointment, which is a really interesting experience because it's the most honest conversation I've ever seen between a patient and a doctor in my life because my dad's not going to change. The doctor knows he's not going to change, which really kind of limits what the doctor's going to recommend he does as far as tests and whatnot. And everyone kind of agrees that he's in bonus time period here. So live your life and, I'll see you in 6 months or whatever, right? But my dad, the reason I bring this up is nobody on my dad's side of the family lived past 60. He has trust me, he hasn't had a fruit or vegetable since the 80s. He's not, he's in great shape other than that. I don't understand how it's working, but it's working, but he planned for it. My mom just passed at 90. Nobody on her side of the family lived past 70. You got to plan for that. And that's like, what, 30 years past retirement? It kind of makes all this stuff that we talk about. We have a chart in here. We won't talk about it. Remember all we talked about was tariffs? Remember Doge? Doge was just last year, and it was supposed to end the world, right? All these issues come, go, come, they go, right? What doesn't? You might live 30 years after retirement and you have to plan for it, right? So if you do those other three things, you'll be ready for it. Always kind of keep your eye on that prize. And again, politically, half the time you'll win and half the time you'll lose. You can't get out of the game the half the time you lose because then when you think you'll get back in, market's moved on. The market does not care if you and I are in it. We take our chips and go home, it doesn't care. It's going to wake up the next day and just operate just fine without us. So you got to stay in that game and again have that plan. So that's kind of where it really matters. But I know there's a lot of stuff going on in the world. There's 16 other slides that we didn't get to. You're lucky. And the Mariners just lost 3-2. So my day's going downhill here. I don't know what earnings look like, but I'm sure they've posted. So with that, I'm going to be done with my part and turn it back over and see where you guys want to go from here.
Yeah, Mark, thank you so much. I do have a couple of questions. And actually, Alex, if we can bring up the presentation again, there are a couple of slides at the end that they are disclosures. And I just want to make sure that from a compliance point of view, we have them up as I asked, the question. So, Mark,
Absolutely.
you mentioned a couple, well, you addressed the oil. Actually, we're getting a lot of questions about oil prices and things like that. Yesterday, something interesting happened. The UAE pretty much left the OPEC. Um, does that mean that market now is going to become an open market or free markets? Or
I
what?
don't know. I
What's your
saw that. I saw that too. I do think it opens up. There's already been interesting things going on in the Middle East, right? There's already been countries that have been trying to diversify away from just being kind of oil as their source, much more technology, tourism, all of that. So they've kind of been looking at it, and I don't know if this current situation is starting to enable or empower maybe different countries to say, look, maybe this, you know, entity that we formed in OPEC, made sense when we did it. But, in particular, remember, it was formed, we weren't in the game, right? And I mean, now you've got energy and you've got now different sources of energy. And while it takes a long time to transition from one source to the other, because technology needs to make it economically viable, the more that you start having other energy sources that are not from the Middle East, it kind of, if you're running a country, you kind of go, well, maybe this is a time when we really should move this ball forward, use this political event as maybe a catalyst to say, should we be forming and shaping ourselves a little differently? And so, do I need to be part of this group or not? Now, I don't know how much of this, I'm not a political expert. I don't know how much of this is political posturing in order to get different deals or arrangements, or how much of it is legitimate, but we've certainly seen it in other countries that, again, some great technology startups are in places in the Middle East. And again, I mean, tourism is obviously an area of interest. So it'll be interesting to see. And of course, now there's talk too with all this negotiations. You've obviously got Russia involved with anything with Iran. What does this mean for the war between Russia and Ukraine? I just wonder how many other chess pieces are being moved around more than what you and I have any sort of
Mhm.
observation or window into, and we'll just have to see what happens. But I thought that was an interesting nugget that
Yeah.
came out in this whole thing of saying, all right, well, yeah, we'll see where this one goes as well.
Excellent. The second question I have is about AI.
Yeah.
So of course we're getting a lot of questions about AI, but consensus there is like the U.S. economy is being pretty much driven or maintained by all the AI investment that exists out there. Is that where's you guys' point on that?
Yeah, it's one of the reasons we're still not in the recession camp. I mean, the amount of spend by these AI companies has been unbelievable, right? It's like every world project ever done rolled up into one with what's being spent. And sometimes it's hard to imagine how do you get paid back on that. But then again, we kind of, maybe not to this level, but we had a major technological change 20 years ago just with the internet, and here we are 20 years later, and I don't think any of us would have imagined back then that it would basically just be a core part of our entire life in all ways. And whatever was spent back then was probably a drop in the bucket. So I don't know from a company creator standpoint how it works out for them as far as profitability. But I mean, they're certainly getting paid now. Now, we are starting to already see the influence in a lot of different industries. And it's one of the reasons why U.S. earnings are so good. And even though our market's been going up for years, we can still be two-thirds here and be very comfortable because profit margins are good. Now, you might say, yeah, well, I got a college kid that can't get a job. So I'm starting to see the other side of AI. And that's all kind of part of this create, destroy
Mhm.
that, quite frankly, has been going on for 250 years in this country, right? I don't know who the winners and losers will be, but every other technological advance, the early fear is always about what's it going to cost or what's the negative, and you find the positives as you go through it. So I have to believe this one's going to be the same way. Yes, there could be some short-term negatives associated with certain areas, but the impact on our lives and our ability to free up to do other things could keep our economy the number one economy in the world moving forward. We're just going to have to see how that kind of plays out, but it's not going away. And we're just going to have to see how this all works its way through the system. But yes, it's certainly been a driver for operating margins with companies are great for this late in an economic cycle. And a lot of it is because of this AI effect. So, and the US is certainly, yeah, the driver. Now, we're already starting to see the transition, though, from the creators have been paid. That's kind of what I think about the tech names. And now it impacts every other company and starts taking advantage. So as a shareholder, you benefit from that. But again, that might not be appeasing you if your college kid's still at home. My kids are in their 20s and 30s, so they're out and they are employed. But I understand the anxiety that's probably going on depending on what major your child might have come out with. So we're just going to have to wait and see. But yeah, it certainly is. U.S. is the driver, good, bad, and indifferent on all of this stuff. But we're certainly the leader in this space relative to others in the others are users of it in the world, but they weren't the creators of it. Yeah.
Yep. All right. I think that's all for today. I really, really appreciate your time, like always.
That
So,
was a
Alex
lot to
and
chew
Mark,
on. I'm really sorry, but again, extraordinary day to do this call with some pretty big
yes,
things going on. I'll catch up on after hours earnings now from these big companies. And but again, what does it all mean? It's just another day. Market was basically flat. Keep your eye on that 20, 30-year horizon. Keep your eye on the plan and all that kind of stuff. And it's, we're getting into good weather everywhere. Have a hobby, spend time with your grandkids, take a breath. Everybody enjoy their summers. But who knows? By the next time we talk, I think there's going to be a couple things we're going to have more certainty on than we do right now, and we'll talk about it in 2 months, 3 months, whenever that is. So always
yep.
appreciate the opportunity.
Thank you so much. Thank you, everyone. Have a good day.
Be well.